good to have you on the show. The company's managed a good growth led by clearly food as well as the Indian beverage business as I can see it. The food business has given good growth even at a time like this. What do you think went right for you, and more importantly, how sustainable is it?
Yeah, so before I comment on the specific trends going forward, just wanted to highlight that I think we've had a decent quarter in Q3. Yeah. Despite cycling a high base of the previous year, which was up by 23%, we still delivered a 6% top line, 28% EBITDA, 22% net profit. And this is not only the top line results, it is across the board. Working capital improved by 14 days, cash generated was up by 30%. We saw volume growth, including in India beverages, for example. While we reported a 1% revenue, we had a 5% volume growth, which is a critical piece going forward. Market share gains across, whether it is beverages or foods, etc. We've increased number of outlets in line with our stated commitment. We've focused on brand building and upped our A&P spends. Innovation, which is the other piece, is at 2x of where we exited. We exited at 1.5%. We are now trending close to about 3% for this year. So all in all, pretty decent numbers, as you mentioned, pretty decent growths across. The foods business had probably a better run on volume, but that's because we have this huge focus on growing Sampann, which is our foray into the pantry of the Indian consumer. Going forward, we do see a little bit of pressure on demand, and we see pressure with the inflation coming. The good news is we've got different businesses and it's playing out differently, so we're tackling that in a different way. But overall on the demand piece, I think it is more stress on the semi-urban rural consumer. You have to remember the base effect in terms of last year, there was reverse migration, etc. So I don't know how those numbers play out. But we are seeing stress where there is a higher percentage of rural in specific geographies in India. We are seeing stress on the brands which cater to the mass market. Mass premium brands are doing relatively better. And the SKUs, which are lower value, lower volume SKUs, are doing better than the higher volume, higher value SKU. So there is a bit of stress on demand. We've seen that sort of continue into January. February is looking slightly better. So I'm keeping my fingers crossed that we will be growing out of this. But that said, for Tata Consumer specific, I think we remain focused on the medium to longer term to build a large food and beverage and FMCG business. In the beverage space, I think we've got enough of an opportunity to grow share and premiumize, and this will come through distribution, innovation, and brand building. In the foods business, salt is a share gain, and we've got a long runway. We've also launched a lot of new products to cater to that, and of course, distribution. And in the foods business, the other big growth lever is Sampann. Narishco, which is our RTD business, is growing 100% plus. I think the focus is on geographic expansion. Starbucks had a great run last quarter, and we expect as Omicron subsides, we again expect a very good run on Starbucks. Starbucks, by the way, has was all for past few quarters was EBITDA positive. This quarter is EBITDA positive, and PAT PBT break even as well.
Sure. Sunil, do you also see tea volume growth picking up? And would you say that price increases in the rural sector could be major factors here? Where do you see the volume settling in at?
So the good news is, despite all the upheavals, despite a volatile environment, significant inflation headwinds, we did deliver volume growth on tea last quarter. Volume growths in India were up by 5%. Albeit revenue was 1%. And there is a specific reason for that. Over the last, I would say, 18-24 months or so, we've seen a huge up and down in tea prices. September of 2020, for example, compared to 1 year before that, September 19, the prices were up by nearly 70%. And over a period of time, we had taken pricing up, and we were expecting tea costs to come down. Now, tea costs did come down, pricing did go up, but tea costs did not come down as much as we expected because of some specific reasons, specifically drought in a little bit of a drought, I would say, in Assam in the month of May and then in November. So it still settled slightly higher than where it had started pre-COVID, about 15 to 20% higher. That said, I think broadly now the price hikes and the price versus cost equation has settled down. We do not expect tea prices to go up from here. Maybe after the first half of the year, you might see a little bit of softening when the whole crop comes in. So broadly, I think now we're entering a stable environment. As relates to the volume growth specifically, now historically, India has been about a 5 to 7% volume growth and a 2 to 3% price mix growth on top of that. So we do expect that as now the environment stabilizes on the price equation for the consumer, we will start seeing those kind of volume growths coming back. So we remain optimistic that we will go to the 5 to 7% industry growth. And of course, as Tata Consumer Products, we are very, very clearly focused on share gain and premiumization. So we aim to outgrow the category.
Hi, Mr. D'Souza. Now, tea prices as well have come down, but there is continued inflation in other raw materials. So how will that impact your margins?
So if you look at Tata Consumer business, we've got three big businesses. Of course, we've got smaller pieces as well. In India Beverages, India Foods, and International. In terms of margins, International delivered its best ever quarter on margins last quarter, EBITDA margins of about 18%. So that is on a stable footing, albeit coffee prices going up, tea prices going up, inflation going up. So we will calibrate pricing in line with what we see on inflation to make sure we maintain margins. On the foods business, we are seeing inflation, and inflation because of two pieces. The extended monsoon impacted the salt brine, which is available raw material to make salt, and that pushed up prices. And of course, you've got the oil and related downstream inflation impacting it. We took price increases about 15% so far between August and November. And now volume has started to come back. So we remain confident of maintaining margins there. Again, we'll keep a close watch on how it plays out. On tea specifically, we're seeing the reverse trend on tea costs. I mean, tea costs have come down over the last 1 year or so. And like I said, pricing, we've taken up gradually over the last 1 year or so. And broadly, we are in the ballpark of where we need to be on margins going forward. We're in a comfortable space. So as long as we don't see any dramatic changes on tea costs or significant movements beyond what we are seeing right now on packaging, freight, oil, etc., we should be in a good spot.
Let's welcome in a very special guest now. The management at CG Consumer, Mr. Shantanu Ghosla, is here with us. Remember, they have done an acquisition of Butterfly Gandhimati. It's an application into the kitchen appliances business. Sir, can you tell us more about this acquisition? What essentially are the key things to watch out for? What are the synergy benefits?
Obviously, I don't want to talk specifics, but suffice to say, like I mentioned, in the immediate term, it's clearly a lot of growth opportunity in small appliances and an ability to establish leadership brands in small appliances. But in the long term, it definitely is a strategic play in the kitchen. We want to be the most valuable brand, which improves the lives of consumers in the kitchen. And obviously, over the long term, this presents even more opportunities.
Well, that point is taken, Mr. Khosla, but I just wanted to check with you regarding the margins, because the operating margins for Butterfly Gandhimati is around 9%, whereas yours has been around 15%. What should be a margin level which is sustainable going forward in that scenario? Again,
without making any forward-looking statements, we over time definitely see opportunities for synergies, and on the cost front also, as I mentioned. However, we will take the appropriate choice as we move forward, what amount of these synergies we need to continue to reinvest in accelerating growth and innovation, and what flows down to the bottom line. This, frankly, is a very similar approach which we followed over the last 5-6 years of the existence of our company, Crompton Consumer, where we strive to become best in class in cost. That enables us to invest in innovation, the consumer, and growth. And based on the business choices we make over time, part of it may flow to the bottom line also.
The kitchen appliances is about 8,000 crore addressable market, and Butterfly Gandhimathi has grown at 21% CAGR over the past 5 years. What is the growth expectation? What is the market share that you would be looking at? Can you tell us some numbers?
Well, currently, if you look at 4 businesses which make up about 80+% of Butterfly's existing business, and that's mixers, pressure cookers, hobs and stoves, and wet grinders. All of these have roughly plus minus about a 10% all India market share. Obviously, the market shares tend to be higher in the south than in other areas. In terms of what our expectation is in the future, as I've mentioned before when I've talked about Crompton, really our focus is on making sure that we grow our revenue sustainably faster than the market. And by doing that, we expect that we will continue to grow share and build our leadership position.
Mr. Khosla, you talked about a lot of products that the acquisition company has in terms of the kitchen appliances, the grinders, etc. But this is something which is already there in your range as well. So what's the strategy going forward? Will there be 2 brands? Are you looking at collaborating the 2 together?
Yes, we see space in these markets and frankly other segments also in the future of 2 brands coexisting, both a Butterfly brand and a Crompton brand. Both of these over time will have different equities and different positions. Very clearly, as we start off, our small appliances business is really largely made up of geysers and coolers. And we've only just started getting going on mixer grinders. So we're not really that worried about cannibalization kind of issues right now. But in the future, very definitely, we now as a group own 2 brand assets, both strong brands in their own right. One is Crompton and one is Butterfly. We will continue to invest and innovate on both these brands. We will continue to develop distinctive positions for both these brands, but we definitely see them both playing a role and actually increasing our chances of success in the long term.
Right. So what has been the growth and expansion plans across different geographies? How would you look at that?
Well, first is the reality is, as we mentioned, that Butterfly has opportunities for growth in certain regions where they're relatively weaker. Now, there are 2 things which we need to do, which this coming together, if you will, helps. The first is obviously we need to develop and build stronger channel and go to market in these regions for Butterfly. The fact that Crompton already has a base and a reasonably strong distribution channel in these areas will help give the brand of Butterfly a head start. The second thing is, along with the channel, you need to invest in marketing to create awareness, consideration, and then purchase. Crompton's stronger financial capability and size will enable us to make those investments, which may not have been affordable to Butterfly. So we believe that both these things will make the combination stronger than the 2 companies independently. As I mentioned, for the Crompton brand, there is a small appliance channel, where things like pressure cookers, etc. are sold, where Butterfly is very strong in the south, and probably in that particular channel stronger than Crompton. that gives Crompton opportunities for expanding its distribution and availability.
Thank you so much, sir, for taking out time for us. Always good to get perspective from you. Anand Agarwal, CFO at V-Mart, is now with us. So, you have undertaken a price hike of about 8 to 10% across various categories. This is to pass on the price increase that you've seen in yarn. With inflationary pressure still persisting, how many more hikes will be needed so that you can compensate for this increase in overall input cost?
Yes, you are absolutely right. The inflationary pressures are very, very challenging. And in the last 15 years, this is the first price hike that we have ever had to take. So we're not, particularly very happy about taking a price hike because we being a value apparel fashion retailer, we've always sort of absorbed the inflationary pressure so far. But this year, the rise in the cotton yarn prices have been upwards of 50%, and we were left with absolutely no option but to take the price hikes. As of now, I think with the series of 2 price hikes that we've already taken, I do not think that we should look for something more. But it is not ruled out. Also, given the fact that given the war-like situation, the markets are definitely going to be in a bit of tizzy. And further situation, how it develops, it will depend on how the raw material pricing remains going forward. But as of now, we have not taken a decision on any further price hike. The only caveat remaining is the GST increase, which was postponed by the government in the end of December, which was supposed to increase from 5% to 12% on apparel. If that also happens, I think that would also lead to a further increase by at least 7% in the maximum retail price for the end consumer.
Sure, and then that point is taken, and none of the managements like taking price hikes. But in that case, if you don't go for that and the raw material prices keep on increasing, will you be able to absorb these price pressures, and will that impact your margins in that case?
We've always remained a very honest price player, and we have passed on the full impact of the price rise to the end customer. Good or bad, I think the situation is true for all retailers and all participants in the ecosystem. So the consumers really do not have a choice. Now, so far, we have not seen any major impact in the volume drops due to the price hikes. But going forward, if we are forced to take more price hikes, a negative impact on the volumes is not ruled out. Now, having said that, I think on the margins, so far we have been able to maintain the margins because we've been able to pass on the full impact of the price rise on the the retail pricing. And going forward, also, I am not anticipating a very big impact, but you never know. As of now, we are not seeing any impact on the margins going forward.
Okay, so that's good to hear, not seeing a negative impact on the margins, and volume impact is something that is not what you are envisaging as well. But what trend we have seen in the quarter gone by is that while the recovery is quite strong in bigger cities, there is some sluggishness in the rural economy, and that's the word coming in from most of the industry players. What is your sense as far as this quarter is concerned with the impact of COVID waning away? Is rural demand bouncing back?
So that's a very difficult question to answer, to comment on the timing, but definitely we are seeing some impact on the rural parts because we operate in tier 1 towns as well as tier 2 and tier 3 towns. Definitely, while the COVID and post-COVID recovery has been strong in all markets, but definitely what we are seeing is in tier 2, tier 3 towns, the recovery is slightly slower. A large part of that might be because of the high inflation, low wage growth, low Manrega, and lack of infra spend in the rural sector by the government. But with a good harvest season and normalization of the situation post-COVID, we are hopeful that in the next 3 to 6 months we should start seeing things come back to normal.
Have you already started enjoying synergies from Unlimited acquisition? What is the additional revenue expected from this?
Yeah, absolutely. I think we are very gung-ho on the acquisition. We started that operations right on day one with full technology integration and people integration right from 1st of September. And so far, I think in the last 4 months, we're very happy to report that the progress has been very satisfactory. There have been no surprises, and in fact, the operations for the last 4 months also have been profitable, which gives us a lot of hope of improving the situation even going forward. On the synergies side, I think we've inherited a very strong team with a very in-depth knowledge of the Southern India market, which we are fully trying to leverage and increase our presence in South India through more new store openings and also understanding of the consumer and the fashion sense of that different market which we had not been earlier before. The other part also is that there is a lot of value add that we have got in terms of the product knowledge and especially around women apparel, which was not a very core and a strong area for V-Mart in the past, and that is something that we've been trying to imbibe in our core markets of North India also with a great success. I think the litmus test is going to be how soon can we bring the full year operations to normalcy in South India and improve the performance by 20 to 25% in terms of sales throughput, which should bring the overall EBITDA for the South India market to roughly around 5% or so pre-Ind AS, which will still be a little lower than the national average of V-Mart, but that will definitely be a far better number to report for, considering the past track record of that particular chain.